Hi and welcome to Carnegie and our interview with Fingerprint cards. My name is Markus Almerud. I'm an analyst here at the bank. So I got with me Adam Philpott, who is CEO at Fingerprint. Hi Adam.
Yeah. Hi Markus, great to be with you.
Yeah, thanks for coming here and talk to us. You released Q3 earnings this morning. Maybe we just start out with a summary of the quarter and where you are in your transformation journey.
Yeah, no, appreciate that. I mean, we launched the transformation journey a year ago now. As I said at the time, and I've said since, this is an ongoing journey for us. As you think about the transformation plan, we can touch on a few elements today. But before I talk about those, I frame it up in terms of phases. The first phase is about stability, tidying up the company so that we're focused in the right markets and making profit. And in terms of that phase, I think we're at the end of the beginning now. So that's the first phase. We're coming to the end of that. The second phase is around accelerating growth. So then taking those markets we're in and moving into new markets and really coming out the traps with new pipeline and new growth. And then the final phase, which is obviously further away, is moving to operation excellence. And so as I look at the pieces that we've been doing within that transformation plan, in that stability phase, we've been making changes in the portfolio so that we focus on profitable products. We've been making changes to our OPEX, and we can talk about that today as well. We continue to really right-size the company. We've been focused on the balance sheet to make sure we're not spending too much money on debt, but really using our shareholder capital to invest and having a flexible balance sheet we can leverage. We've been focused on talent, and of course, we've been focused on strategy so that we go into new markets to serve them, as well as some of the core markets that we've been in for some time. So I feel good about the progress we're making. There's still work to do. We're still stabilizing, but I feel we're really starting to come to the end of that stability phase, as I said earlier.
Mm-hmm. Because that was actually going to be my second question. That I know that last time we spoke, we were kind of halfway through it, and now you feel that we are at the end, so it's ready for the next step, so to speak.
Yeah, I mean, I would see us coming into the first half of next year and then concluding it somewhere there. Towards the first half of next year. I mean, the other thing I would say is there's also some really positive green shoots. There's some challenges, and we can talk about those, but there's some really good green shoots from the strategic transformation work we've done so far. We are doing this because the company wasn't profitable. We are doing it to make the company profitable. And one of the early indicators that we're seeing is gross margin really start to shift in the right direction. It was very low for a long time. We're now seeing that shift up in a positive direction, which tells us it's really starting to work. OPEX, continuing to push that down, and we're doing what we say we're going to do to right-size the organization. So really positive to see that happening too.
Mm-hmm. One of the biggest news maybe in the report was the decision to wind down PC. So let's talk a little bit about that. What was the background of the decision, and maybe why now?
Yeah, so one of the pillars I talked about was portfolio refresh, where we look at all of the product lines we're in, and we're constantly looking at, are we returning more capital than the cost of capital that we have? So that's really important to us. We did that on mobile. That was, for a long time, not a great market to be in. We've had our eye on PC for a while, and the reason we've had our eye on PC is because it has similar dynamics, similar hallmarks to the mobile business. And what are those hallmarks? Well, very consolidated buyers, right? There's very few buyers, so therefore there's consolidated buying power. Each of those buyers has a lot of weight, and so that becomes challenging in terms of negotiation and price pressure. Second thing, those buyers are by and large based in China. Some of them are global companies, but their procurement's certainly based in China. And so with that, you've really faced price pressure, and there's also some geopolitical challenges that one faces, of course, there too. Number three, very, very price-focused market, super price-focused, doesn't massively value innovation, expects some, but it cares about price above all else. And then finally, there's lots of small players serving that market, and so it's very easy for them to just switch you out in a dime. Those aren't great dynamics for us. We saw that work against us, and that's really not a market that we feel is viable for us in the medium term. Hence, taking action on it and making a decision to focus our capital where innovation is valued, where we can charge a premium for our services, and work with customers who value partnership also.
Mm-hmm. And about the timing of the wind down, what is the timing of the wind down?
So the wind down is immediate. We announced it today, and we are notifying affected employees and clients over the next couple of days. So we're on this immediately. We know how to move fast once the decision is made, and so we're executing it immediately.
Mm-hmm. Mm-hmm. And talking about wind down, where are we on the mobile?
Yeah, so I think we've seen mobile play out very well. We did the right thing for our employees. We did the right thing for our customers as well. We were able to monetize that because that asset was of value, and in doing so, hand our customers over. So we've pretty much concluded the mobile wind down. We've liquidated the stock. Customers are handed over. Of course, there is a minor long tail. There'll still be a trickle of small business that comes through, but nothing very significant, and certainly not with any meaningful margin, which is why we got out of that market in the first place.
So is it fair to say that if you look at Q3, you saw a sequential increase in revenues? That was you pushing the products you had left out. Is that how it should?
That's right. That was the conclusion really of the business that I expect to see. And again, I'm not offering this as guidance, but I expect to see a small amount of businesses. We continue to mop up, some of the smaller orders that still come through, but really nothing major, just a minor long tail that you would expect with any business, as opposed to a complete end. But nothing of any interest, I wouldn't say, in terms of any magnitude of business.
And if I look at the company where you have been and where you are right now and where you're gonna be once all this is done, I mean the company is gonna be doing access basically. So let's talk a little bit about access. What are your thoughts? What is the focus? What is maybe the customer concentration? Because we're talking about customer concentration in both PC and mobile. How is it different in access?
That's right. And so similarly, like all of our business, we use that same framework. Are we returning more? Are we getting a better return on our invested capital than we're spending on it, right? And so just as we've looked at mobile and PC, of course, we've looked at access and other markets as well. And so similarly, we look at the dynamics. Whereas those earlier markets were highly consolidated and China-centric and price-driven, we look at access. Very fragmented market, many customers. That brings its own challenges, so we need a different strategy around that because we move from being a volume to a value player across many customers. Still, net aggregate volume, but across lots of customers. So lots of smaller customers. They really value innovation as well. So as you think about that fragmentation, it's not, of course, every market's price sensitive, but it's price sensitivity within the realms of valuing innovation. Right, so they do value innovation. They appreciate we are a premium product as well. And Allkey, I think, is a good example of some of the innovation we're bringing to market, and we can talk about that in a little bit. So fragmented market, very different to some of those other markets. Valuing innovation, very different. They also bring other opportunities as well. Whilst Allkey allows customers to be able to integrate on their own, and it takes a lot of complexity out of the consumption process, the adoption process, some customers do want bespoke, particularly as you go to the top of the pyramid and you get to larger companies. Then you can offer things like design services as well. So those are monetary opportunities for us also. The other thing I would say is those customers are global. They're not all in China. Of course, China has a big manufacturing base, but we've got lots of customers in the US, lots of customers in EMEA, Middle East, Africa, outside of China in Asia too. So we see lots of growth potential by focusing on that market. But the other thing I would say is because it's fragmented, we're dialing up our channel strategy too. To reach lots of customers, you can only reach what your capacity enables you to reach. So we take on additional capacity through our channel partners. We have partners that aggregate and give us more capacity. So that's a really important part. But without having a product like Allkey, that makes it very difficult because then ultimately it still comes back to you and you're the bottleneck if it's not easy for the customer to consume. So you can see how we think about the market, we think about its growth potential and its earning potential, and I think we've showed a sustainable margin in access. And then we think about how we reach that market and how we need to tweak our products to be able to reach the market in that way. So all of those things in the value chain are very tied together, very joined up.
And before we move on to Allkey, do I read you right that also because the customer concentration is different and you become more of a value player, then gross margin should be better, we should have more stickiness, all of those things, right?
Yeah, that's exactly right. That's exactly right. I mean, here's an interesting dynamic. It's very similar to some other products as well, but you know, what we're doing is embedding fingerprints into our customers' products. Then what our customers are doing is building those products and taking them to market. So there's a level of natural stickiness in those products. You know, they're not going to decouple it midway through. And actually, you know, if those products are super successful, then it drives demand. And so, you know, it's very sticky market to be in for a company like ours. Once you're in, you know, super sticky and less chopping and changing on product cycles in many of those companies too.
And maybe a couple of words on Allkey, which is a new product for you. It'll come into production in Q4. So explain a little bit what it is.
So Allkey really is, it's a packaged product where instead of just giving a very basic sensor, we give the full package. We give the software, the packaging, a variety of different bezels on there for different use cases. We give the software development kit. So we're not just thinking about, here's the product, stick it in. We give options around how they can integrate that product and software capabilities to enable them to do so. So we're really handing them all the keys, so to speak, that they need to be able to implement. So it's not just about having the best product, it's about thinking about how our customers can easily consume it. You know, it's meaningful innovation. It's about consumption, easy to use, taking complexity out of the building cycle, which therefore takes cost out of their overall design cycle. Not only that, but it's a product, it's very versatile. It's not just access-based fingerprint product. There's also, it's flexible in its use cases because there's swipe up, swipe down, swipe left, swipe right. So that there's a variety of other things they can do if they have a screen or a menu. Instead of having to have a second ability to swipe or buttons, they can have a much more elegant design using the fingerprint sensor for multiple purposes too. The final thing I would say is that we're standardizing on it. In the past, we almost had one product for every customer. We designed something and we ended up with a myriad of, you know, different part codes and complexity. Very difficult to manage a supply chain in that way. Instead, we're standardizing, right? So it's flexible for the customer, so it meets myriad use cases, so they don't need to pick from 20 products. But for us, it means we simplify our design and our manufacturing process to take cost out, to be able to offer more value to our clients in return. And then finally, as you think about how we sell it, I talked about the channel. The channel then doesn't need to stock thousands of products. They can stock one with confidence, knowing that they've got a really wide aperture of use cases they can meet, and we can help them drive demand accordingly.
And then maybe before we go on to the cost base, the other core that you have left is going to be payments. So where are we on payments? What's happening in the payment area?
Yeah, I mean, I would say on the payment side, it's been frustratingly slow. It's been frustratingly slow. However, we're impatient, and our investors are impatient. But if we compare it to other market cycles where we've created a new market, pretty much similar. Think about mobile. Very successful in mobile. We were not successful overnight. It took a long time to be successful in mobile. So I don't want to be complacent. You know, I find it frustratingly slow because I'm impatient. But, you know, I think it's not unexpected. However, there are things, we don't just sit and wait and say it will be all right. There's things we need to do. Last year and the year before, but particularly last year, we got a lot of stock into our partners. Our partners wanted to now buy the products. We spent a number of years building the product. Last year, they bought the product because they wanted it in stock to go out and start to sell and drive trials and things like that. Now what we're focused on is saying, okay, that stock's been in there a little while. We need to focus instead of building things. You know, we've already got that in flight. we want to focus on demand. And I talked about this earlier, about this notion of input, throughput, and output. As you think about your sales funnel, input is when you bring new deals in, new opportunities or leads. Throughput is how quickly you pass them through the funnel, and output is when they pop out the end in closed deals. I think in payments, we don't have an input issue. We've actually got a pretty decent funnel. We have a throughput issue, which is leading to an output issue. No point in me focusing on output. The deals are stuck. I need to move them through the system. You know, banks can be a little slow. So the focus from the team is now to look at, okay, how do I drive those deals through that pipeline? What barriers are needed to be removed from me, from our ecosystem, from the customers? What do we need to do to drive that through? So we're really focused on throughput and driving those deals through the pipeline. They're legitimate deals, but they're too slow. So we're focused on pace.
But as we move on to cost, again, if I understand things right, we are at the situation where you're basically just waiting for this market to take off. It will not drain a lot of capital to continue to be there.
Yeah, I'm nodding, but we're not waiting for the market to take off. We're pushing the market to take off.
Yeah.
But your broad statement's absolutely right. You know, we're not putting extra dollars into this market. We've done some upfront products work. We've done some really good work with our ecosystem. We've baked in product that will be successful in the market. We don't need to put extra dollars on that. So really, it's a case of managing the ecosystem, working with the ecosystem, and we are invested in that. We continue to work with them on a regular basis. I have regular meetings with the ecosystem myself as well, but no, not investing additional capital. This is why I kind of refer to it as it's like an upside on access. You know, it's an upside bet. We've made the bet. We don't have to put additional chips on there or raise or call or anything like that. You know, we are pushing then the market so that that bet does return in due course.
Mm-hmm. And about cost, I mean, you're taking another beat on cost. So you're looking for 150 million operating cost at the end of this year. And now you're lowering that with you exiting PC, you're lowering that target to 70 million krona per year as of mid next year.
That's right.
So maybe talk a little bit about that, and in particular where R&D cost comes into that, because it's a big part of the cost base.
Yeah, no, that's right. And so it's the exit from PC is very much aligned to that OPEX takeouts, right? The bulk of the cuts are in PC. You know, there may be a few extra ones that we can find as we downsize, and you can find efficiencies and so on. So, but it's all driven largely by PC. PC is also a pretty big team. You know, it's a very large team in China, and it's a big team too. So there's a reasonable amount of capital tied up there. When I say China, I of course include Taiwan as well. And actually, that's a big part of this too. Is we've exited mobile. Is we exit PC, we've therefore exited our China-centric business. We're no longer focused on, you know, China-centric customer markets, which is also really important to us. It's been a very challenging, price-sensitive, and geopolitically challenging place to do business. It was always something we've spoken about. We are now. That's why I kind of refer to the end of the beginning, rather, because that is a really important pillar in that stability phase. So we are coming to the end of that, as I said, coming into that next year. But we are coming to the end of that beginning phase. And so with those cost takeouts, doesn't impact our core business, doesn't impact our access business, doesn't impact the payment bet that we've already made either.
Okay, and I mean, you used the word end of the beginning, and you're about to enter the new phase, kind of the growth phase of the business. So without giving forecasts, when we stand here for 12 months time from now, what will you look like, you think? And where do you expect to be on your journey in a year's time?
Yeah, great question. So I expect to have a stable core business. As I said, you know, the end of the beginning, coming into next year to the middle of the year, as we get into the second half of the year and moving into that new phase. That's kind of how I'm thinking about it. So very early in that growth phase. I think stable core business, as I said. What are some of the things, the indicators that we'll see as well? We'll see new partnerships. We'll see new partnerships that we're working with, either incoming to us or people that we're working with to expand our reach and our offer in the market. And included in that, we will have taken tangible steps forward on our new strategy. I've talked about our new strategy, but we finessed it over time, and now we're getting really close to looking at who we want to partner with, how we want to invest in order to really tangibly execute that strategy. So we'll see those things as we come in 12 months' time. Those are all things that we'll absolutely have in place.
And tied to that, but maybe a little bit shorter time frame. As we go into next year, what's going to be your number 1 and 2 focus for the next 6 months?
Yeah, I would say if you ask for 2, I'll give you 2. One is to make that transition from stability to growth. So to do that, we first need to be stable. So, exiting the PC business is absolutely a core part of that. Doubling down on access is a core part of that. So really ensuring that stability is tidied up, locked away. That's exactly why I talk about the end of the beginning, because we can't just constantly be stabilizing. We are now coming to the end of that phase, and that's kind of number 1 priority for me now, is to conclude that phase. Second thing is to then put a foot into accelerated growth. So what do we mean by that? Making sure that we are developing new products on the edge. Earlier, I talked about our strategy in terms of edge and cloud, right? Edge is where we are today, to develop new products there, both within the fingerprint and iris space, but also extending into other modalities, probably through partnerships. So to be extending what we're doing in the edge, that's the second priority, top of mind, to execute our strategy. And of course, the same in the cloud as well. So that moving into that growth space by continuing to develop and expand our product offering on the edge and in the cloud as well. If those are the 2 things, stability, growth, those are the 2 priorities, and those are some of the things that we need to do within them.
Adam, lots of things going on. We're running out of time, but thank you for coming here to talk to us. Really looking forward to see the next 3 to 6 months and see what's going to happen. So thank you for coming here to talk to us.
Great to see you, Markus. Thank you.
Thank you.